Okay, so good morning, everyone. Welcome to today's macro snapshot. We are Wednesday, February the 14th, 2024, which of course is St. Valentine's Day. So may there be lots of romance in your life today and this evening. Okay, so let's get back thinking about what happened yesterday. We obviously got higher than expected CPI data. And so we have to sort of say, well, what does this mean for the Fed? We had, a bit of a sell-off in the equities, quite an aggressive, actually a very aggressive sell-off in the bond space, but especially the front end of the curve. So let's just sort of do a little bit of sort of thinking here and say, what does this mean? I mean, I think the first thing to say is that this means that the Fed will definitely want to be looking at more data. You remember that Jerome Powell and other people were saying, many, many times that they want more confidence in the numbers. They want to see, 2 or 3 or 4 data points going in the right direction. Yesterday, as CPI definitely was not going in the right direction. And just looking at some of the underlying measures, like for shelter, for owner equivalent rent, for services, the so-called super core, which is the services stripping out the sort of shelter. That's definitely going in the wrong direction. And something like the super core, if you actually annualize it, which is a bit imperfect, but I think it was over about 10%, 10.8% annualized. So the basic line is that whichever way you sort of cut and dice the data from yesterday, it's not going in the right direction. And at the very minimum, we can say this will cause the Fed to want to look at more data. So the data we have coming up, we have PPI. We have PPI revisions this morning, but I don't think that's going to be market moving. We do have the new PPI coming out on Friday, but historically the Fed doesn't really look at that enormously. So the question is, from a market and trading point of view, if we get lower than expected PPI this Friday, will that cause a major rethink, and will that cause the market to rethink the PPI from the CPI from yesterday? I don't think so. At the margin, it could cause, a little bit of, volatility. But I think for the Fed, they really need to be seeing the PCE numbers, which will be coming out on February the 29th, so in a couple of weeks. Of course, we get another reading of the CPI March the 12th, and then we have the Fed's meeting itself on March the 22nd. So essentially from today, we have about 5 weeks with a lot more data to come. And I think the Fed will say, well, okay, we absolutely want to look at that data. And secondly, we need to see what's going on. Was yesterday just some kind of sort of seasonal blip or something like that? Or was it the beginning of sort of, the narrative that inflation actually is a lot stickier than we thought, maybe not transitory anymore, but intransigent? And if that is the case, I mean, the market will have to reprice a lot of things. So at the moment, let's look at what the market's saying and what the Fed is saying. The Fed is saying, according to their most recent dot plot in December, and we'll get another one in March, that there are going to be 3 cuts in 2024 and 4 cuts in 25. So that makes a total of 175 cuts. Now, what the market is pricing at the moment, and you can look here on the SOFR tool on the CME website, which is pretty useful. It's a new tool they have. This is what the market is currently pricing in. Yesterday, we saw that the market priced out about 25 basis points. So if we actually just have a look at a couple of things here, before we get back to that, we can just have a look. So what we're seeing now is that for the March meeting, 2 basis points are priced of cuts, which essentially is, let's call it sort of 0. But what's interesting is that now for May, we only have 10, so it's about a 40% chance. And then the first cut now has been pushed back to June. So that's pretty interesting. If you look at, let's say, something like March, if we go back, let's say, for example, a month, we can go back to, I don't know, even the beginning of this year, let's say Wednesday, the 3rd of January, and just look how much that's changed. Is that back even 5 or 6 weeks ago, the market was assigning about a 75% chance of a cut in March, and then 1.6 cuts, so about 41 basis points by May, and then by June 66, so almost like 2.5 cuts. So obviously that's been completely changed. And the point I'm trying to make is that not only was yesterday's number a game changer, but actually the week or two leading up to yesterday, we had the strong sort of payroll numbers last Friday. So the point is that there's a whole narrative now of the narrative before was that, the economy is doing quite well, but the Fed would still be cutting. I think what's very interesting now is that the narrative seems to be the economy is doing well, or perhaps even very well, and the Fed will cut, but possibly a lot later than the market had anticipated and by a lot less. So the question is, so far, as we see this year, we've had about 25 up to 50 basis points, 1 to 2 cuts taken out. We had one taken out yesterday. And you can see that if you look at, let's say, like the curve of the SOFRs, which is, the short-term interest rates, the 3-month interest rates. And this blue line here, this is the yield. So this is the implied yield going forward. So you can see we're kind of here, and you can see going out to 24 and 25. I might even just zoom that in a little bit more, just make it a little bit more exciting. So I'll take it out to the end of 25. And this is basically what the market is pricing at the moment. And you can see that this blue line here is from a week ago. So that's from the 7th, which is exactly 1 week ago. And what you guys can see is that all the way out for the next sort of 18 months, the yields have been pushed up a lot. And this is what happened yesterday is a little bit more. So it wasn't only yesterday's CPI, it was also the strong economic data and Fed speak, sort of a pretty hawkish Fed speak we've been getting over the last week or 2 or 3, which has pushed up. So the question now is, is that it? Is that enough? What happens if we get, higher than expected PPI or lower than expected PPI? What about the economic data? Because the point is that the market has come a lot closer to what the Fed was saying. And remember that the market was pricing in 6 or 7 cuts this year, whereas the Fed was saying only 3. So really now the big question is what will the Fed maybe even become a little more hawkish and take out a dot, sorry, at the dot plot in March, maybe remove one of their cuts. Remember, the Fed is pricing in 3 cuts, not pricing it. They anticipated, forecast 3 cuts this year and 4 in 2025. So will all of this sort of strong data and maybe CPI and who knows, maybe PPI and maybe another CPI going in the wrong direction cause the Fed to actually become a little bit more hawkish? But let's just see, so what are the trades at this point? I mean, what's interesting is that if you look at what's priced in by the market is still pricing in 1, 2, 3, 4 cuts for this year. Okay. And then if we put in, let's put in the Fed's ones for next year. So let's say, we put in 100 cuts for 2025. We can do that there. Actually, I might do that there. So what I've done here is to put in this is essentially what I'm saying is what the Fed is saying. So we have 4 cuts next year. And then let's say we take out one here. And let's see what happens. So let's say, for example, we take out 2. That means there's only 2 cuts. Actually, what I'm going to do, I'll take out one for the election cycle. So essentially what I've done here, it starts off with what the market is currently pricing. And what I've done is to put in what the Fed could signal in March. So only 2 cuts in 24. And then a full 4 cuts in 25. And if we recalculate that, what's kind of interesting, you can see that there's quite big changes. So what you can see here is that the current price is the red one, and you can see that the blue one is much lower. And what that actually means is that you see here is that especially for, let's say, the June, but let's say the September and December SOFR contracts, you see that these guys would come down a lot. You see here the difference, 37 basis points, and for December, 30 basis points. So what that's telling us is that, yes, the market, I'm going to reset this here. Yes, the market hawkishly repriced yesterday and has done so over the last couple of weeks. But if the Fed were to sort of take out one of those cuts from the SCP, the Summary of Economic Projections in the March meeting, the SOFR, like the 2024 SOFR contracts have another 30 to 35 basis points, which is about 60 to 70 ticks to go down. So they could be more hawkishly repriced. So what is interesting is that maybe where we're getting to is a point where something like the 2-year, if we just start looking at a couple of the charts here. So let's just go back onto some daily charts here. I mean, what we're seeing yesterday, for example, just looking at the price action, we're seeing this is like the 230s curve. We saw that bear flattened quite a lot. It's coming back a little bit today, steepening, but it had been bear flattening for the last, kind of 10 days or so. And so the point is that it wasn't only yesterday, it's also been this drumbeat of aggressive and hawkish Fed speak, and also this drumbeat of strong economic data. So the question is there more to go? I would say yes, it's possible. We could definitely on the 230s get down to, minus 25 basis points. What would cause that? That would cause the Fed to continue to be hawkish in their communications. And obviously, if, for example, PPI comes in line or higher than expected, and of course, if the CPI next reading comes in higher than expected, and if the economic data continues to be strong, we have retail sales coming up on Thursday, initial jobless claims. If that kind of data continues to come in strong, this whole narrative will continue to be pushed of the economy is doing great, the Fed is going to be more hawkish, and so the curve could continue to flatten. If we look at the 10s, 2s, which is this one, a similar kind of situation here, where could that go? That could definitely go down to, let's say, 36 or maybe even another, 10 or 15 basis points. So there could be some more pain there. On the other hand, if we look at the yields, you can see that the 2-year yield, not only yesterday where we had this big move up, so let's say, for example, yesterday, the 2-year yield, sorry, let me just do this. The 2-year yield yesterday, rose about 18 basis points. But the point I'm trying to make is that it's in the last sort of couple of weeks, it's actually gone up 52 basis points, which is 2 cuts. So the point is that, are we getting to a situation where, let's say the 2-year and the 5-year, which have taken quite a lot of pain over the last couple of weeks, not just yesterday, and this is the 5-year yield now, similar kind of situation. I mean, the 5-year yield is getting up this point up here to 436. I mean, I don't know if I'd be an aggressive buyer, but is that going to be some kind of cap? Because at some point we can presume that the economy will weaken a little bit. Now, whether that's going to take 6 or 12 months, but at some point that will weaken. And at a certain point, we may expect as well that the Fed will actually cut. And so you've got to say that something like the 2, but especially maybe the 5-year yield, it's taken quite a lot of pain and has risen quite a lot. And maybe we're getting to a point where that will start to represent value. Because you have a bit of extra duration. You have, the 2 years or maybe 5 years, which is not the same as, let's say, a SOFR contract for this September or this December, which is only 6 or 8, 9 months away. So the interesting thing here is that it could be a point where, something like maybe, for example, selling September or December SOFR contracts, but buying, let's say, for example, maybe December 25, so doing a bit of a spread. And the idea here is being that the cuts will come, but they might come later, more in the, let's say, later part of 2025, rather than in 2024. So that could be an interesting trade. Or another interesting trade idea based on this thesis, if you like this thesis, could be something like selling, September 24, so September 24 SOFRs, and maybe buying, for example, the 2-year, or maybe buying the 5-year. Something like that could be quite an interesting little trade. So that's the kind of thing which is going on at the moment. In terms of the equities, we have NVIDIA coming up on, where is that? I think it's on the 20th. So the equities obviously having a bit of a sell-off. Yesterday we see, the ES down. We also see NASDAQ coming down. The Russell was hit quite badly, a bit more sensitive to sort of domestic interest rates. But the point is that, if you look at something like ES, I don't need you guys to, for me, I don't need to tell you guys that it's had an incredible run up for many, many months. And if you look at something like a Fibonacci extension here, which I'll try and put on the chart, you'll see that, a pause and a pullback was kind of due anyway. I mean, as by one measure, you could say that that's completely sort of oversold. And if you look at NASDAQ, a similar kind of situation. So I do believe that we're in a situation where the economy is doing well. There's a sense that, okay, maybe the Fed will cut a bit later, but the Fed will still cut. And, we're pretty close to we're definitely at the top of the hiking cycle, most probably, and in a very, very strong economy. So, and we've had quite good earnings. So it could be that the market's in a situation where this could be a buy the dip situation. So, and already today we're seeing a little bit of a bounce back. I don't know, could there be more pain if, the Fed comes out and says some stuff or whatever. But I just think that we are still, it's maybe not all over in the stocks. It's still maybe a buy the dip situation. I think what's going to be important, and we're not there yet, in a week, is going to be NVIDIA, because we all know that that's been ripping and going parabolic and is very important, not only for the numbers, but also for sentiment. So let's see how NVIDIA goes. But I think, the market's like, okay, the Fed might be a little bit more delayed in delivering cuts, but at the end of the day, they will deliver cuts. And whether it's in, March or June or July, it looks like the stock market can sort of deal with that. So just quickly, guys, obviously yesterday we had, just on the back of that, we had a strong US dollar reaction. We see the yen, just keep an eye on the yen. We had some comments overnight supporting the yen just by the Ministry of Finance over there. Just keep an eye on this one. I think the dollar, could definitely push up towards, let's say the 151, 152 mark here, 152 on the spot price here. The Japanese authorities overnight were talking about, potential intervention and wagging their fingers and looking very serious. But the reality is this is based on fundamentals. And, as long as those interest rate differentials between the US treasuries and the JGBs are sort of spreading out a little bit, which by the way, is also the case with Europe, the differentials are spreading on the yields. I think there's a good possibility that the US dollar could push up towards 152. At that point, it might be interesting, might be worth dipping the toe in at that point for some kind of short, especially if, maybe the PPI comes in a bit softer, there's a bit more talk of intervention from the Japanese authorities. So that's that. The other thing as well, just keeping an eye on oil. Yesterday, to sort of show you guys, we had API numbers. Let's just refresh our memories. On the API, there was, it's seasonal. There was a very, very large build of 8.5 million barrels. But on the other hand, the gasoline, as you can see, was a serious drawdown. And this build, just for seasonality, is not all that unexpected. And the gasoline is very supportive. Cushing building up a little bit, and distillates minus. So if you actually look at the products here, we see that heating oil is doing pretty well, gasoline, distillates. So keep an eye here on the refined products. Let's call it minus 11 million. We have the official government numbers, DOE, today at 10:30. So and if you actually look at the chart, just quickly have a look at the chart for oil here, you can see that oil actually is sort of breaking out a little bit. Where are we? I'll just bring it up. I mean, gasoline doing very well, so just pushing gasoline. Don't worry about this. This is just the contract roll, but definitely gasoline is pushing up here. And we see that for oil, oil has sort of this Fibonacci, which I was looking at yesterday. So if we actually put this one here, you look at a fib here, you can see that the 61.8 definitely broke all the way through that and is pushing up, quite possibly towards the $80 mark. I think that it might have a bit of a pause and a pullback here, but if that's bought on a dip here, if we have the idea that the US economy is still doing quite well, there's some little signs of, improvement in China. Europe seems to be doing okay. Who knows? Maybe oil, can continue to sort of push up a little bit based on, the Saudi and OPEC cuts continuing. We shall see with that one. Okay, guys, it's gone a bit long today. I'll leave it there. So have a great day. As I say, I hope it's a romantic day for everyone, and we'll keep on talking. Thanks very much.